Hey everybody, welcome to your weekend review for the week of Monday, April 3rd, 2023, and oh, what a week it was. MBS started off the week being up 5 basis points. Stock were up just a little bit in the morning. Bonds lost ground the moment the overnight trading session opened on Sunday night, owing to a quick surge in oil prices driven by an OPEC supply cut. Crude oil futures advanced 6%, the most in almost a year, after the cartel announced an output reduction of more than 1 million barrels per day. This is hot off of some news that Saudi Arabia and several other companies are banding together to stop using the dollar for oil trading, which is bad. In a slightly bigger picture, this returned oil to levels seen before Silicon Valley Bank failure. After the initial losses, bonds were pretty much sideways through most of the morning. Manufacturing economy contracted in March, according to the ISM manufacturing survey. Supply chains are now ready for growth as panelists' comments support reduced lead times for their most important purchases. Oil is going to hurt that. Price instability remains, but future demand is uncertain as companies continue to work down overdue deliveries and backlogs. 70% of manufacturing gross domestic product is contracting, down from 82% in February. Sentiment around the Fed policy is slowly shifting in the wrong direction for better rates, at least. As more time passes, the banking drama of a couple weeks ago doesn't appear to be as systematic as some Chicken Little voices would have led everyone to believe. It's hard to expect rates to make any significant improvements this week ahead of very dangerous jobs data coming on Friday. More evidence of bank deposits run on the last few weeks is abating. Raymond James points out that smaller banks are actually gaining deposits now. Overall, the deposits did fall, but they came out of larger banks and the foreign domiciled ones. The jobs report on Friday will be the big event of the week, along with ISM data. The bond market will close early on Friday as well, so it'll make for a choppy day and a lot of people trying to predict things in advance. They don't have to come in on Friday. FHFA is making COVID-era 6-month deferral payment options permanent. This allows borrowers to skip up to 6 monthly payments and then tack them on to the end of the mortgage should they have hardship. At the end of the day, we were up 13 basis points, which puts us at 101.14, which moves us into kind of a brand new range right there. That downward trending light blue line is our 200-day moving average with a ceiling at 101.671. Relative to the rest of the chart, it is kind of a wider range with several different floors on it. So we could see some bounciness in the next couple of days, especially with jobs data coming. For agency mortgage bond investors, the hits keep on coming in the month of March, and it was a hard kick in the teeth for the sector. The U.S. MBS excess return came in at minus 1.11%, the worst performance seen in the month of March in the history's index, easily besting or worsting, however you want to look at it, the former record low seen in 1994 when it tallied minus 0.97. Throw in some volatility as investors and the Fed disagree over what the monetary policy should look like in the second half of the year. Add a dash of potential agency MBS sales by the FDIC's seizing of assets. They could possibly sell off a whole bunch of those MBSs from Silicon Valley Bank. Garnish with continued hawkish rhetoric from the Fed speakers, and then mix an inflation rate that using PCE remains well over twice the target. You've got yourself a little bit of a wall of worry. So that last section was from Chris Maloney over at Bank of Oklahoma. So good work to him.